Hey everyone, welcome to the KE Report in a daily editorial, a pre-market daily editorial on Friday, August 29th, chatting with Joel Elconin. Joel is the co-host of the PreMarket Prep Show. Click the link in the show notes to listen to and watch Joel's pre-market show. A lot of good information on a wide variety of stocks. Joel is also the founder of the Stock Trader Network, also linked in the show notes. Joel, let's talk markets and this general melt up that we continue to see. I feel like over the last few months, we keep hearing about how big tech is leading. And then all of a sudden, there's different leadership and rotation into the small caps. And then the value trade is leading. It just seems like this constant rotation where markets are melting up. There seems to be just this drip of money coming into the markets, which means the broad averages keep moving higher. And at certain times, one outperforms the other. But quite frankly, everything seems to be simply moving higher. It is a slow period for the market seasonally, as we are just about to end summer, head into the Labor Day long weekend, and then who knows what comes when we change the calendar to September. But Joel, your assessment on this market environment, again, of markets simply melting up and leadership changing seemingly on a weekly basis.
What you see in the market right now is directly tied to the Fed and interest rates. If you thought that a dovish Powell was priced into the market, you found out on Friday you were wrong, that 800-point rally. What is most sensitive to interest rates are your small caps, and the small caps are responding in kind, furious price action over the last week. Also, the value trade. Big tech doesn't care about interest rates, they're cash cows. So while you had the mega cap tech rally, many near all-time highs, you had a part of the market was dragging. And now with the aura of lower interest rates, investors are flocking into the IWM, the IBB sectors that are more interest rate sensitive.
Yep, we've seen the small caps finally respond, expecting that lower cost of capital because they generally need to borrow money because they're not revenue generating companies or not producing the same kind of revenue as the mega caps. But when you look at just the broad indexes, those are also melting up. I mean, to Corey's point, it really is kind of an everything rally here. There is rotation under the surface, but when you look at the S&P 500, I know you're an S&P guy, Joel. I mean, we're up near 6,500 right now as we talk. We're at 6,496 and some change. What do you think the propensity is to get to a 7,000 handle this year?
Oh, wait, yeah, 7,000? I mean, I'm not going to say, first we got to think about 6,600. And first of all, we have to clear the 6,500 and make 6,500 support. The only reason, you don't want to get super excited here is there are some things that upset the apple cart. And we'll just talk about those briefly. The Fed's preferred gauge of inflation is PCE. You get that tomorrow. Next Friday, you get jobs data, right? The following week, you get PPI and CPI. Looks like none of those statistics are going to sway the Fed in order, not to lower in September. But I will say, you have to have a cautionary tale, especially after that PPI that you got. I think what's going to happen in the market is you have a very inflationary environment, and along with inflation, stocks are part of that, and they're going to be inflated. Then you're going to get more fuel for the fire with lower interest rates. And what people are going to be dealing with in the second half, or sometime next year, is inflation and perhaps slowing growth. That's stagflation. That's ugly. That's not what the market wants. But you know what? You can't trade, you can't invest thinking about what may happen next year. You have to YOLO and you have to trade and invest for the moment. And that's where we're at right now in this market. You have the other catalyst, ahead. Will it change the Fed stance in September? Maybe not, but I'm sure you're all aware what Trump is doing to reshape the Federal Reserve Board, firing Lisa Cook. I mean, he's going to have control of that. Is it good in the short term? Yeah. Is it good in the long term? To be determined.
Such a good point, Joel. The YOLO, you need to invest for right now because as much as I've even heard all these market commentators over my many years in the markets try to point to long-term moves. Look at this is going to happen and in the long term this is how it's going to play out. Quite frankly, you can miss a whole lot of opportunities in the short term. But if we're talking about everyone investing for the here and now and yeah, maybe in the future things get really tough. Does that mean that you should have some sort of a defensive position on in case there is a quick market downdraft? Or should you have cash because market downdrafts seem to be buying opportunities?
Well, cash is trash, right? In an inflationary environment. We've gone over this on, several different occasions. Everyone has, different investing horizons, styles, and expectations. And you just have to stick with that. I think what's interesting now, another thing that's providing a little bit of a boost to the market, is that people got head over heels with the IPOs and now they're coming back down to reality. So yeah, I don't think you're going to get that big whoosh down. I think you just have to be prepared to buy at consolidation areas, and if it drops, buy some more. There seems to be a insatiable bid out there in this market. And until you get a negative catalyst, which I just mentioned, there could be three or four, just slow and steady wins the race. And I mean, you can buy all the protection you want, you can buy all the puts that you want, but it will just be eating into your real return. On the other hand, if you're selling calls, if you're selling upside calls, what you're doing is you're capping your upside, right? Because if the stocks keep going, and if they fall really hard, then you're only covered for the premium that you took in from selling the calls. So right now, no. I mean, you should be invested or nearly fully invested and staying with the market trends.
The trends are either friends until they're not, and it seems like the propensity of traders are still have that underlying buy the bid mentality. Until that changes, it doesn't seem like there's anything that can derail these markets. Of course, you say that, and then something may come right around the corner and surprise you. But we've covered this year all the crazy things that have happened, and the markets have shrugged them off and kept blasting higher. People are more tuned into what's going on in the earnings reports, and I always like to get your thoughts, Joel, on what you're seeing in the earnings. But I think we should maybe started off with Nvidia. They put out their Q2 earnings and they actually exceeded estimates. They put out 46.74 billion as far as their revenue, but it's kind of been a non-event. There was so much posturing on both sides, the bearish and the bullish. This is such a watch stock. It's such a huge part of the indexes. What are your thoughts on the fallout post Nvidia earnings report?
I mean, there was a super high bar, right? Because of the price action that you've had in it and the expectations in the market. You had so much hype in it, you almost felt like it was going to be a non-event. And we discussed off air the straddle, the expected move, which at this time it hasn't even, never even came close on the upside and missed it by a few bucks on the downside. So what that tells you, and there was some algo jumpers out there ahead of the actual report, they got it up over 183, close to 184, but it was met with sellers. And then when the actual report came in and they started to hit it, it didn't get near the expected move. And then now, has rallied back. Very high bar based on the price action, very high bar based on the atmosphere that you have in the markets, and they didn't clear the high bar, but for the time being. But you always like to watch that closing price on the day of an earnings report to see what people make their decisions. Right now, you're down to $1.44. That's basically a non-event. So when the street gets that hyped up over one report, sometimes there's too much emphasis on it, and there's a lot of other things going on in the market besides Nvidia.
You're right. There is, but still, it was a high bar, and it seems like they met it, which is still saying something because boy, oh boy, that stock has been on a tear, and just look at how much it's valued at as well. What about the broader earnings picture here, Joel? It seems like there were some moves actually on the back of some earnings, but the tail end of the earnings season seemed to be much quieter. So, what caught your eye? What got attention in the markets and what was ignored?
I think that there were a couple surprises in the cloud space. Snowflake was sitting in the doldrums, traded way down in the pre-market, and now that's having a good move. MongoDB had added nearly 100 points yesterday, tacking on another 20 today. So maybe, the other tech, your heart, your cloud, those stocks are maybe getting a little bit of a focus. Google quietly sneaking up and made a new all-time high and breaking out. Amazon been slow and steady. Apple, I mean, they, even on the reports that they hit them, they seem to buy the dip, and then it's hard to shake that mentality. The market is, it's not really punishing the good stocks for, subpar, or okay results. It's just they're meeting expectations. There's been a lot of emphasis on guidance, and the guidance has been pretty good. I mean, I think the overall riding factor more than like the earnings is, are you in with Trump or are you out with Trump? I mean, look at the price action in Apple just when they announced that investment. Look how that's reacted. Intel gets the investments for the United States, from the US government. So earnings were fine, no super disasters. And if you beat the bar, that wherever it was, you've been rewarded. So that's just the mentality in the market right now.
Well, Joel, I'm glad you brought up Intel and the investment by the U.S. government. We've seen the U.S. government invest in a couple equities in our neck of the woods in the commodity space, but Trump recently came out and said he wants to see the U.S. government investing in more equities and specifically some defense companies. Do you feel like there's a line that gets crossed if the government's directly investing in stocks? I mean, I know it's like subsidizing crops in a way, but when you see the government taking part, you eventually will have the haves and the have-nots. And do you feel compelled to get in with the momentum if the government's actually becoming a stakeholder in some of these companies?
Well, I certainly work with MP Materials. It's yet to be determined with Intel. But when it comes to Intel, and I mean, making the comment about the government investing in, U.S. companies, that doesn't seem very conservative to me or part of the Republican stance, but I will reserve comment on that. It's dilutive. The move they did for Intel was dilutive, but Intel needs to make better chips. They got to figure it out. So they can get that, the government taking a stake in it, but does that make better engineers? Do they make better chips? Are they going to get market share from Nvidia? Are they going to take market share for AMD? That remains to be seen. Just because the government took a stake in them doesn't mean that it's an automatic turnaround for the company.
Yeah, it's very true, but it is a nice lifeline and just interesting to see the government buying equities. It's a bit of a change. We'll see how much more they will do of that, but I guess Trump is trying to spur some sort of growth, I guess, in the country or within some of these companies. But Joel, when it comes to the small caps, let's focus a bit more on the small caps because those have been outperforming, those have been doing quite well, but I don't believe they're back to all-time highs. Very close to some all-time highs. Do you think that that is kind of the major resistance here? That if small caps get to all-time highs, it could lead to a whole other leg higher?
I mean, they've been underperforming for years. They got back up to the all-time highs just recently, had a sufficient pullback, and now they're coming back up there. So, had trouble above 240 in 2021. At the end of 2024, you got up there in November and December. You're coming right back to that area. So, yeah, I mean, talk about playing some catch up here. Still not above the post-COVID recovery highs. A lot of room here on the upside and could, yeah, incite, another leg. As long as the scenario which has been painted of lower interest rates, yeah, you got to look at the IWM, you got to IBB. perking up lately. That's nowhere near its all-time high that it made in 21 as well. So all these factors are pointing to the same thing, and that is the path of least resistance is higher until it's not. And the small caps, they've just been lagging for years, and maybe it's time they play catch up.
Joel, how do you think the lower rates, if they're coming in September, at least most people believe they are at this point, how does that affect the financial sector? Any currents that you've seen under the surface as far as the financial stocks that you watch?
I mean, it's good for the banks, right? Generate, interest rates come down, generate loans, generate mortgages, help them, with some of the bad, deals that the on had on the books. Any relief in interest rates makes it more attractive. XLF trading at an all-time high. I mean, you guys could keep me on here forever and trying to get me to say something bad, but I mean, it's just how long have we been mentioning the Goldilocks scenario? Actually, I heard them talking on CNBC about it. So, yeah, the financials, yeah, why not? Just give me just about anything. Another, yeah, good, buy it. I mean, that's the kind of environment that we're in. I mean, I'm sure there's some other dogs out there, but speaking of, Peloton hasn't rallied, but I mean, that was a pandemic thing. Yeah, I mean, it's just, I guess the other thing, I guess the word of caution here is that we're coming into retail season. And if there's a big drop off in some of these retail stocks, then that's showing some sign that the consumer's getting a little bit stretched. And it might be time, to ring the register. But then the Fed comes to the rescue and lower interest rates, and everyone's happy.
So well put, Joel. I'm not even going to bother trying to get you to speak negatively on anything else because, quite frankly, you are right. Right now, a lot of sectors, most sectors are continuing to melt up, and that is something that I think investors should be bracing. I know everyone's always trying to pick a top, but it's also nice just to ride the wave and continue to, I guess, lock in some earnings, move up your stops if you are having those, and quite frankly, make sure that you are invested to take advantage of this simply good Goldilocks, as you have said for a while now, environment. Again, Joel Elconin is the co-host of the PreMarket Prep Show. Click the links in the show notes to find out what he's talking about today and on his recordings. Joel, thanks for your time today.
Okay, thank you guys.